Welcome to the deep dive. Ever feel like business taxes are just designed to be confusing?
Huh. It can definitely feel that way sometimes.
Well, today we're tackling one structure that lots of small businesses use, but it has some tricky bits. We're diving into the S corporation.
That's right. Our mission today is pretty straightforward. Unpack the S Corp. We've looked at the rules, the regs, the common questions, and we're going to boil it down to what you really need to know. Make it clear, make it useful.
Okay, let's unpack this then. So when you first incorporate a business, the default is usually a C corporation, right?
Exactly. That's the starting point for most. But an S Corp, well, that's different. It's not a default, it's an election. You actively choose it.
An election. So you're telling the IRS, hey, treat us differently.
Precisely. And the big difference, the really fascinating part, is that it becomes a flow-through entity.
Flow through,
Oh,
like a partnership.
kind of, yeah. Similar concept. The S Corp's income, its gains, its losses, deductions, they aren't taxed at the company level. Instead, they flow through or pass through directly to the shareholders.
And the shareholders report it on their personal returns.
You got it. On their individual 1040s.
Okay, but here's a point that seems crucial. You get taxed on your share of the profits, even if you don't actually take the money out.
Yes, that's a huge heads up. Shareholders are taxed on their slice of the earnings whether or not they receive a distribution. So you could have a profitable year on paper,
Leave all the cash in the business bank account.
and you still owe personal income tax on those profits. It catches a lot of people off guard. Cash flow planning becomes really, really important.
No kidding. Okay, so this S-corp status sounds pretty useful, especially the flow-through part. But you mentioned rules. Who actually qualifies? Is there a test?
There definitely is. It's not for everyone. There's a specific eligibility checklist you have to meet. 4 main things, really.
All right, let's break them down. What's number one?
First, it has to be a qualified corporation. Basically, that means it needs to be a domestic U.S. corporation.
Okay, formed in the U.S., simple enough.
Mostly.
Yeah.
An S Corp can own stock in a C Corp, even 100%. But, and this is key, they can't file a consolidated tax return together.
Ah, okay.
But, on the other hand, an S Corp can set up what's called a qualified S subsidiary Q sub, sometimes own it 100%, and basically file as one entity.
Interesting. So domestic corp, check. What's next?
Number 2, eligible shareholders. This is where things get a bit more specific.
Uh-oh. Specific usually means complex.
Sometimes. Generally, shareholders have to be individuals, estates, or certain kinds of trusts. And here's a big one. No non-resident alien individuals allowed as shareholders. That's a complete deal breaker.
No non-resident aliens. Got it. Any exceptions?
Yeah, a couple of surprising ones.
Yeah.
Qualified retirement plans like a 401k plan, and certain 501c3 charitable organizations can actually be shareholders.
Really? Okay. Who can't be a shareholder?
This is another common trip up. Neither C corporations nor partnerships can be shareholders in an S Corp.
Right. So individuals, estates, some trusts, some nonprofits,
Yeah.
but no C Corp partnerships.
Okay.
What's number 3?
The shareholder limit. An S Corp can't have more than 100 shareholders.
100.
Yeah.
That seems like a fair number for most small businesses.
It usually is. And there's a helpful rule here for families. Family members, and this is defined pretty broadly, like common ancestors, their kids, grandkids, spouses, even former spouses, can elect to be treated as just one shareholder for this 100 count limit.
Oh, that's handy. So a big family business could still potentially qualify.
Exactly. Gives you some flexibility.
All right, so domestic corp, eligible shareholders, under 100 shareholders. What's the last one?
Number 4, the one class of stock rule.
Meaning?
Meaning the S Corp can only have one type or class of stock outstanding.
Yeah.
All shares have to have the exact same rights when it comes to getting distributions or getting paid out if the company liquidates.
Okay, identical rights. But what about voting?
Good question. Differences in voting rights for common stock are actually allowed. So you can have voting common stock and non-voting common stock. That's fine.
But no preferred stock.
Absolutely no preferred stock. That would create a second class of stock and disqualify you.
Wow. Okay, that is quite the gauntlet of requirements. Domestic corp, right? Shareholders, no C Corp, partnerships, non-resident aliens, 100 shareholder limit with family aggregation, and only one class of stock. But voting differences are okay. You really have to nail all of those.
You do. And getting it wrong or falling out of compliance later, well, that can terminate your S status.
Which we'll get to. But first, let's say you do meet all these criteria. How do you actually make the switch? How do you become an S Corp?
It starts with paperwork, naturally. You need to file Form 2553, election by a small business corporation with the IRS.
Form 2553. And who needs to agree?
All shareholders have to consent. Voting, non-voting, everybody signs off on that form.
And timing matters, I assume.
Critically, if you file Form 2533 by the 15th day of the third month of your tax year.
So, March 15th for a typical calendar year company.
Exactly. If you hit that deadline, the S election is effective right back to the beginning of that same tax year, January 1st.
And if you miss the deadline, file on, say, April 1st.
Then the election generally won't take effect until the start of the next tax year, so you'd remain a C Corp for the current year.
Okay, so timing is key for that initial election. Once you're an S Corp, does every new shareholder have to sign something too?
Interestingly, no. Once the election is validly made, it stays in effect. New shareholders coming in don't need to reconsent. They inherit the S status.
That simplifies things a bit. And how about filing taxes each year?
S corporations file Form 1120-S, that's the U.S. income tax return for an S corporation, and they generally have to use the calendar year unless they can show the IRS a really good business reason for using a different fiscal year.
And the deadline for that 1120S?
Same kind of timing. It's
Yeah.
due by the 15th day of the third month after the tax year ends. So again, March 15th for most folks.
March 15th seems to be a very important date for S Corp.
It definitely is. Election deadline, filing deadline. Yeah. Mark your calendar.
Okay, so we know how to become one and how to file, but you mentioned earlier that you can lose S Corp status. That sounds bad. How does that happen?
It can be, yeah. Losing S status means you typically revert back to being a C corporation with double taxation and all that potentially implies. And it can happen a few ways.
Like what? Can you just decide you don't want it anymore?
You can. That's the first way. Voluntary revocation. If shareholders who hold more than 50% of the stock counts, both voting and non-voting shares, agree, they can file a statement with the IRS to revoke the S election.
Okay, so the owners can choose to end it. What about accidentally losing it?
That's the second, and often more common way, failing to meet eligibility requirements. Basically, if the corporation stops meeting any one of those 4 rules we just discussed.
Like getting an ineligible shareholder.
Exactly. Let's take an example. Say small corporation is a calendar year S Corp. On February 1st, they bring in a new investor, large corporation, which is a C corporation, giving it 40% ownership.
Uh-oh, C Corp can't be shareholders.
Right. So small corporation's S election terminates immediately on February 1st, the day the ineligible shareholder came on board. Poof.
Gone. Wow, instant termination. Okay, so violating the rules is a big one. Any other ways?
There's a third, slightly more complex way. Excess passive investment income.
Passive income,
Yeah.
like rents, interest, dividends.
Yes, exactly. If an S corporation gets more than 25% of its gross receipts from that kind of passive income for 3 consecutive years,
3 years in a row.
and this is a critical, and the corporation also has leftover earnings and profits, or E&P, from when it used to be a C corporation.
E&P, that's like retained earnings from its C Corp days.
Sort of, yeah.
Yeah.
Its profits accumulated and taxed under C Corp rules before the S election. If both those conditions are met, too much passive income for 3 years and prior C Corp E&P, then the S election terminates at the beginning of the 4th year.
Okay, that's specific. Only applies if you were a C Corp before and have that old E&P and have too much passive income for 3 straight years.
Correct. If the S Corp never had C Corp E&P, this rule doesn't apply.
So, revocation, failing eligibility, or too much passive income with C Corp history. And if you lose S status, what's the penalty box like? Can you just re-elect next year?
Not usually, no. Once an S election is terminated, the corporation typically has to wait until the beginning of the 5th tax year after the termination year before it can re-elect S status.
5 years. Ouch. That's a long time to be potentially stuck as a C Corp again.
It is. It really underscores why staying compliant with those eligibility rules is so crucial. Ongoing monitoring is key.
Absolutely. Okay, that covers eligibility, election, and termination. Now let's get to the really juicy part. How the money actually works. The pass-through mechanics. How does income and loss flow to the shareholders?
This is really the heart of the S Corp structure for many people. Like we mentioned, it's similar to partnerships in that ordinary business income or loss, plus various separately stated items, pass through to the shareholders.
And you mentioned it's allocated. How? Based on ownership percentage.
Yes, but specifically on a per share per day basis. So if you own 20% of the shares for the entire year, you get 20% of each item. If you only own them for half the year, you'd get roughly half of that 20% allocation. It's prorated daily.
Per share, per day. Got it. Makes sense. Now, you hinted at a big difference from partnerships earlier. Something about taxes.
Ah, yes, the big one.
Hmm.
For S Corp shareholders, even if they work actively in the business, their share of the corporation's ordinary business income is not subject to self-employment taxes, Social Security, and Medicare taxes.
Really? That's huge.
Right.
Because partners in a partnership do pay self-employment tax on their share, right?
Generally, yes, active partners do. So, for an owner-operator, structuring as an S Corp and paying themselves a reasonable salary, with the remaining profit flowing through without self-employment tax,
Mm.
that can be a significant tax-saving strategy.
Okay, that is a big aha moment. Now, you mentioned separately stated items.
Yeah.
What falls into that category versus just regular, ordinary business income?
Yeah, good question. Think of ordinary business income as the net profit or loss from the company's main operations. You start with gross income, subtract cost of goods sold, salaries, rent, utilities, regular depreciation, the usual business expenses.
The day-to-day stuff.
Right. But certain items have special tax characteristics, so they need to be reported separately on the shareholder's Schedule K-1. That's the Form S-Corp used to report each shareholder's share.
Why separate?
Because they might be subject to different limitations on your personal return, or they get taxed at different rates, or reported on different tax forms entirely.
Examples.
Sure, things like net rental real estate income or loss, interest income, dividend income, royalties, net short-term capital gains or losses, net long-term capital gains or losses.
So investment-type income mainly.
Often, yeah. Also, Section 1231 gains or losses, that's usually from selling business property, charitable contributions made by the corporation, and even the Section 179 expense deduction, which lets you deduct the cost of certain assets immediately.
Section 179 is separate. Why not just part of regular depreciation?
Because the Section 179 deduction has an annual dollar limit that applies at the taxpayer level, meaning your total Section 179 from all sources is limited, so the S-Corp has to pass it through separately so you can apply your own limit. Regular depreciation, like in MACRS, doesn't have that same type of overall taxpayer limit, so it just gets factored into the ordinary business income calculation.
Okay, that distinction makes sense. Can we walk through a quick example?
Definitely. Let's use Grade Corporation again. Say they have $150,000 in sales. They deduct $70,000 cost of goods sold, $40,000 in salaries, and $10,000 in regular SCRS depreciation.
Okay, so far that's $150K minus $120K. $30,000 left.
Right. The $30,000 would be their ordinary business income. But let's say Graycore also earned $10,000 in interest income from CDs, had a $5,000 gain from selling some old equipment, that's a Section 1231 gain, and donated $4,000 to charity.
So those three things.
Huh.
Interest, the gain, the donation.
Yeah. Those would be separately stated. The K1 would show $30,000 ordinary business income, $10,000 interest income, $5,000 Section 1231 gain, and $4,000 charitable contribution. They don't get lumped together.
Got it. And that Section 1231 gain often gets treated as long-term capital gain on the personal return, right?
Usually, yes, which is another reason it's stated separately, potentially lower tax rate than ordinary income.
Makes sense. It's like sorting different types of income and deductions into the right buckets before they flow through.
Exactly. Precision is key. And don't forget, there's also the potential for the Section 199A qualified business income QBI deduction on that ordinary income flowing through. That's another 20% deduction shareholders might get on their personal return.
Right, the QBI deduction. Another layer. Okay, one more tricky area. Fringe benefits. Like health insurance for owners.
Ah, yes. This trips people up constantly. The rule depends on your ownership percentage. For regular employees who aren't shareholders, or for shareholder employees who own 2% or less of the S-Corp stock, the corporation can deduct the cost of fringe benefits like health insurance, just like any other business expense.
Simple enough for them. But what about the owners with bigger stakes?
For shareholder employees owning more than 2% of the stock, the S-Corporation generally cannot deduct the cost of those fringe benefits.
Cannot deduct. So it's not a business expense.
Unless the cost of that benefit is included as taxable wages on the shareholder's Form W-2.
Ah, so the company pays for the health insurance, doesn't get a deduction for it directly, but adds the premium amount to the shareholder's W-2 income.
Exactly. The shareholder pays an income tax on it, but then they might be able to deduct it on their personal return as self-employed health insurance, potentially. The key is it must be included on the W-2 for the corporation to pay it, essentially. If it's not on the W-2, the corporation can't deduct it, and it gets complicated.
Okay, so more than 2% owners get those health insurance premiums added to your W-2. Crucial detail.
Very crucial. It's a common audit issue.
I bet. So it really is like a finely tuned machine. Ordinary income, separately stated items, QBI, fringe benefit rules, all flowing through based on that per share, per day basis.
Yeah.
And always remember that passkey. You're taxed whether you get a distribution or not.
Couldn't have said it better myself.
All right, let's shift to another absolutely fundamental concept for S-Corp shareholders, basis.
Yeah.
You called it an investment scorecard earlier. Let's dig into that. What is basis and why is it so important?
Basis is, well, it's essentially your economic investment in the S corporation for tax purposes. It's the benchmark used to determine if distributions you receive are tax-free returns of your investment or taxable income. And crucially, it limits how much loss you can deduct.
Okay, limits losses. We'll come back to that. How do you figure out your basis? What goes into it?
You start with your initial investment, the cash or property you contributed to get your stock. That's your starting stock basis.
Makes sense. Initial contribution.
Then, your stock basis increases over time by a few things. Any additional capital contributions you make, your share of the S-Corp's ordinary business income, your share of those separately stated income and gain items.
Like the interest income or capital gains we talked about.
Exactly. And interestingly, even your share of tax-exempt income, like interest from municipal bonds held by the S-Corp, increases your stock basis.
Even tax-exempt income. Why?
So that when you eventually receive that cash as a distribution, it comes out tax-free, reflecting its original tax-exempt nature. Basis tracks your ability to receive distributions without further tax.
Okay. Increases make sense. What makes basis go down?
Distributions you receive from the S-Corp reduce your stock basis, but not below zero.
Yeah.
Also, your share of non-deductible expenses.
Like fines or penalties the S-Corp paid?
Yeah, or things like 50% of meals expenses that aren't deductible, those reduce basis. And of course, your share of ordinary business losses and separately stated loss or deduction items like that charitable contribution.
So income gains contributions increase it, loss distributions decrease it. Fairly logical. Is it exactly like partnership basis?
Very similar, but with one major difference. S corporation shareholders do not get to include any share of the S corporation's debt in their stock basis.
Ah, so if the S-Corp borrows $1 million from the bank, that doesn't increase my stock basis at all, unlike a partnership.
Correct. That's a huge distinction. However, there's a wrinkle. If you, the shareholder, personally make a direct loan to your S corporation.
I lend my own money to the company.
Yes. Then you establish a real debt basis. It's separate from your stock basis, but it's also tracked. It starts at the amount you loaned.
And does that debt basis change?
It can. If the S-Corp makes payments back to you on that loan, your debt basis decreases. Importantly, like stock basis, neither stock nor debt basis can ever be reduced below zero.
Cannot go below zero.
Okay.
Okay, let's try an example for basis. Jane Gray again, 50% owner.
Okay, let's say Jane initially contributed $25,000 for her stock. So initial stock basis equals $25,000. She also loaned the corporation $20,000 directly, so initial debt basis $20,000.
Got it. 25K stock, 20K debt. Now, year one happens.
In year one, let's use our earlier numbers. Gray Corp had $30,000 ordinary income, $10,000 interest, $5,000 Section 1231 gain, and made $4,000 in charitable contributions. It also distributed $21,000 in cash total. Jane's 50% share of each.
Okay, 50% of 30K income is $50, 50% of 10K interest is $50K, 50% of 5K gain is $2.05K, 50% of 4K contribution is $2 loss deduction item, and 50% of 21K distribution is $10.05K.
Perfect. So we adjust our stock basis, start with $25,000, increase by income, 15K plus 5K plus $2, $25,500, and decrease by the contribution 2K and the distribution $10.05K.
So $25,000 plus $22,500, then minus $2,000, $45,500, then minus $10,500. That's $35,000 ending stock basis for year one.
Exactly right. Her stock basis ends at $35,000. And since the S-Corp didn't repay any of her loan, her debt basis is still $20,000. No, wait, let's adjust that slightly. In the source example, they say debt basis decreased by $2K repayment. So debt basis would be $18,000. Let's stick with the source's numbers. Ending stock basis $35K, ending debt basis $18K.
Okay, ending stock basis $35K, ending debt basis $18K. That scorecard analogy really works. You see exactly how each piece affects your investment value for tax purposes. Now, you mentioned basis limits losses. How does that work? This seems critical.
It is absolutely critical. This is the tax basis limitation. The rule is simple but harsh. You can only deduct S corporation losses on your personal tax return up to the amount of your total tax basis.
Total meaning stock basis plus debt basis.
Yes. You add your stock basis and your debt basis together. That sum is the maximum amount of loss you can claim in that year.
What happens if your share of the loss is more than your total basis? Does the extra loss just disappear?
Thankfully, no, not immediately. Any loss that exceeds your total basis is called a suspended loss. It's not deductible now, but it's carried forward indefinitely.
Carried forward, so I might be able to use it later.
Yes, you can deduct that suspended loss in a future year, but only if and to the extent that you increase your basis in that future year.
How do I increase basis in the future? More income, more contribution.
Exactly. Your share of future S-Corp income or gains will increase basis. Making additional capital contributions increases basis. Even making more direct loans can increase your debt basis, which helps absorb losses too.
Okay, so suspended losses wait for future basis. Is there a catch?
There is. If you sell or otherwise dispose of all your S corporation stock while you still have suspended losses carried forward, those losses are gone forever. You lose the chance to deduct them.
Wow. So you really want to try and create basis to use up those losses before you sell.
Ideally, yes. Or at least be aware you might lose them. There's also a specific ordering rule when basis is restored by future income.
Ordering
Yes. If you had losses that reduced both your stock and debt basis, potentially to zero, any future basis increases from income or gains must first be used to restore your debt basis back to its original amount, or less if repaid. Only after debt basis is fully restored do further increases go to stock basis.
Restore debt basis first, then stock basis. Okay, let's use Jane Gray again to see this loss limitation in action, year 2.
Right. We ended year 1 with Jane having $35,000 stock basis and $18,000 debt basis. Total basis, it could equal $53,000. Now, let's say in year 2, Gray Core has a really bad year and incurs a $120,000 ordinary business loss.
Ouch. Jane's 50% share is a $60,000 loss.
Correct. But her total basis is only $53,000?
So she can only deduct $53,000 of that loss on her year 2 tax return.
Precisely. The remaining $7,000 loss, $60,000 share minus $53,000 basis, becomes a suspended loss carried forward.
And what happens to her basis after deducting the $53,000 loss?
It gets wiped out. The loss first reduces stock basis to zero, $35,000 used up. Then it reduces debt basis to zero, $18,000 used up. $35,000 plus $18,000, $53,000 total basis used. She ends year 2 with $0 stock basis and $0 debt basis.
Zero basis and a $7,000 suspended loss hanging out there.
Okay.
Now, year 3, hopefully things turn around.
Let's say they do. In year 3, Gray Core has $60,000 of ordinary business income. Jane's 50% share is $30,000.
Okay, $30,000 income. Now, how does that affect her basis and that suspended loss? Remember the ordering rule.
Right. Debt basis gets restored first. Her debt basis was $18,000 before the year 2 loss wiped it out. So the first $18,000 of her $30,000 income goes to restore her debt basis back up to $18,000.
Okay, $18K used for debt basis. That leaves $12,000 of income. $30,000, $18,000.
That remaining $12,000 now increases her stock basis, taking it from $0 up to $12,000.
So now she has basis again. So, okay, stock, $18K debt, total $30K. What about the suspended loss?
Now that she has basis, she can finally deduct that $7,000 suspended loss from year 2.
So the $7,000 loss is deductible in year 3. And that deduction itself reduces her basis again, right?
Yes. That $7,000 allowable loss will reduce her stock basis. So her ending stock basis for year 3 would be $12,000 minus $7,000, which equals $5,000. Her debt basis remains at $18,000.
Okay. That's a multi-step process, but
Right.
walking through it makes it clear. Income restores basis, debt first, then stock, which then allows suspended losses to be deducted, which then reduces basis again. Wow. Keeping good records seems absolutely essential.
It's non-negotiable, really. Without accurate basis tracking, you can't correctly determine the taxability of distributions or how much loss you can deduct.
Makes perfect sense. Okay, one last major concept that often causes confusion, the accumulated adjustments account, or AAA. Sounds like basis maybe, but different.
It sounds similar, but it serves a very different purpose. AAA is not shareholder basis. It's a corporate level account.
Corporate level, okay, what does it track?
AAA essentially tracks the cumulative amount of the S corporation's income and losses that have been taxed to shareholders during the years the S election was in effect, but haven't yet been distributed. Think of it as a running tally of undistributed S corp earnings.
Undistributed S-Corp earnings. Why track that separately?
Its main function relates to distributions, particularly for S corporations that used to be C corporations and still have some of that old C corp E&P hanging around. AAA helps determine the tax treatment of distributions in those cases. It helps distinguish between distributions coming from S-Corp earning, generally tax-free up to basis, versus distributions coming from old C-Corp E&P, taxable as dividends.
Ah, okay. So it's most relevant for former C Corp making distributions. What are the key rules for AAA?
The most important rule regarding distributions is that while distributions reduce AAA, they cannot reduce AAA below zero.
Cannot go below zero from distributions. Okay. Can AAA itself ever be negative, though?
Yes, absolutely. AAA can become negative if the S corporation has losses and deductions. Losses reduce AAA, and they can drive it into negative territory. Just distributions can't take it below zero.
Got it. Distributions stop at zero, but losses can push it negative. What increases and decreases AAA specifically?
It generally increases by ordinary business income and separately stated income gain item.
Similar to basis increases.
Similar but not identical. One key difference. Tax-exempt income increases shareholder basis, but it does not increase AAA.
Oh, interesting. Tax-exempt income skips AAA. Okay. What decreases it?
Ordinary business losses, separately stated losses and deductions, and non-deductible expenses, like that 50% meals disallowance, reduce AAA. Again, similar to basis, but expenses related to tax-exempt income reduce basis but don't reduce AAA. And as we said, distributions reduce AAA but not below zero.
Okay, let's run Gray Core through the AAA calculation quickly. Assume it started with $0 AAA. Year one numbers again. 30K ordinary income, $10K interest, $5K rate gain, 4K contribution, 21K distribution.
Right, increases. 30K plus 10K plus 5K plus $45,000. Decreases. 4K contribution plus 21K distribution equals $25,000. So ending year one AAA equals $45,000. $25,000 is $20,000.
Ending AAA is 20K. Now, year two with that big $120,000 ordinary loss.
That loss directly reduces AAA. So $20,000 starting AAA minus the $120,000 loss means ending year two AAA is negative $100,000.
Negative $100. Shows losses can definitely make it negative. And year three with $60,000 ordinary income.
That income increases AAA. Negative $100,000 plus $60,000 income means ending year three. AAA is negative $40,000, still negative, but moving in the right direction.
But AAA is really tracking that cumulative profitability while it's been an S Corp, separate from shareholder basis, mainly to sort out distributions if there's old C Corp money involved.
That's a great way to put it. It's a corporate level measure of S Corp era earnings.
Wow, okay, we have covered a ton of ground today, from what an S Corp even is to who can be one, how to elect it, how you can lose it.
All the way through how income and losses flow, the critical concept of basis and loss limits, and finally that distinct AAA account.
It's clear that while S Corp offer potential benefits, especially that avoidance of self-employment tax on profit distributions, they come with a lot of specific rules you absolutely have to follow.
Absolutely. Understanding these details isn't just, academic. It's vital for making smart financial and tax choices, whether you're thinking about becoming an S Corp or already operating as one. Getting it right can save you money and headaches. Getting it wrong can be costly.
Definitely. So for you listening, how does all this detailed information change how you think about business structures? Did anything we discussed today really stand out or surprise you?
Digging into the S Corp details like this really drives home a broader point. Choosing your business entity isn't just a one-time legal step. It's an ongoing strategic decision with significant tax and financial implications that needs constant attention. So the final thought I'd leave you with is this. What does this constant need for vigilance and understanding mean for the crucial relationship between business owners and their tax advisors? And maybe more broadly, how does the very complexity of structures like the S Corp shape the way small businesses navigate growth and plan for the future?
That's a great question to ponder. Lots to think about. Until next time, keep digging into what fascinates you.